Good day to all Inderes TV listeners and viewers. Tecnotree published its Q1 results yesterday, and on today's video we will discuss that with CEO Padma Ravichander and CFO Indiresh Vivekananda. Welcome, Padma and Indiresh.
Thank you.
Thank you.
So we can start the video interview as usual, if you could go through the highlights and challenges of Tecnotree's Q1.
Well, we started the year with strong results as far as I'm concerned. Achieving another quarter of positive free cash flow makes it 4 continuous quarters of free cash flow, which is a record for the company. Shows operational effectiveness in our management while continuing to deliver strong revenue growth in mature markets as well as emerging markets. Also a significant improvement in the DSO and collection process. As you can see, our initiative started last year in Think Cash, Do Cash, and this year we have made significant progress towards reducing the DSO days. We've also successfully expanded geographic diversification in Americas, and our recent announcement in Q2 for a European opportunity definitely says that we are entering these markets with a very stable product stack. This time's revenue also, in terms of the quality of the revenue, a lot of the revenue came from licenses. And of course, most of the revenue, the strong growth also came from MEA, APAC. Well, we are continuing to show a strong pipeline of opportunities in America and Europe in terms of growth of the order backlog. In terms of challenges, what I see is that Q1 is a small quarter. It's also a slow quarter because the start of the year, and generally, if you look at the cyclical nature of the quarters, Q1 definitely is a smaller quarter, both in terms of revenue and EBIT. Our EBIT could have been better, but while we did a lot of cost cuts last year, I think the termination costs and the restructuring costs were also affecting the EBIT this year. So all in all, I would say it was a very strong quarter for the company.
If looking at the new orders, they were quite low as the order book came down. So maybe what is behind this, and is there room for concern?
Well, actually the orders for Q1 went up by 15% compared to Q1 of last year, which means we have actually demonstrated a better growth in the quarter-to-quarter comparison. Overall, it's slightly lower than last year, but I believe that's seasonality, mainly because a lot of the deliveries are happening out of the order backlog from last year. There is a very strong pipeline, as I already mentioned, and we are confident at this point in time that our guidances remain on track both for revenue, EBIT, as well as for the free cash flow.
So you mentioned the EBIT was somewhat lower than it could have been or expected. So maybe if you could talk a little bit more still about the factors that burden the profitability in Q1.
Indiresh, you want to?
Sure. Yeah. Thank you, Ronnie. As you can see, my revenue grew slightly higher than the last year, and in constant currency also we did grow more than the last year. But again, as you said, that EBIT is almost at the same level of last year. The main reasons are a slight increase in our average employee cost. There are one-time costs that are associated with whenever we reduce the headcount, there are always one-time costs that come and hit us. So there's a one-time cost that has gone into our Q1 results. And again, as we have promised last year, we had said that the actions on employee reduction and the other cost reduction measures what we have taken, that is going to yield about 7 million savings in 2025. And I believe we are on track of that. While Q1 EBIT was lower, we are given a guidance that our current year EBIT margin will be 200 basis points higher than the last year, which we hold, and we are continuing the same guidance, and we are confident of meeting that.
If thinking about the revenue split geographically, we saw that Europe and America decreased a little bit. So is there anything to be worried here since your strategy is to grow in these markets?
I don't think there's any particular concern about the markets. In fact, we have a global spread. We grow in emerging markets as much as now we have diversified into mature markets. That doesn't mean we do not continue our growth in Africa or other emerging markets. In fact, double-digit growth for BSS continues to be strong in African markets, and not all African countries suffer currency fluctuations or currency risks. Therefore, growth in mature markets remains a priority because there is opportunities to rip and replace legacy products of our competitors. We are seeing a good reception and acceptance of Tecnotree's platform because it's TM Forum standards compliant and it's state of the art in terms of microservices orchestration, as well as the number of features the platform has out of the box, 4,500 features. So the revenue last year in Q1, just a point to note, included non-telco services that we were providing through the acquisition of Cognitive Scale, which we now have we have retired those revenues. We are not pursuing the non-telco AI/ML opportunities. All the AI/ML activities are now focused on telecom, embedding those use cases into our telco journeys and our services on our platform. Therefore, I think that comparison it reflects that change.
Yeah, that's a good point. You announced a deal in Netherlands yesterday as well. So maybe if you could talk about this deal, what more can you tell about it? For example, approximately how big is it and for how many years it is going to be?
Yeah, it's a multi-million-dollar deal and it'll span multi-years, probably 4 to 5 years, if I'm not mistaken. It's an anchor account in Netherlands. It's a very strategic win for Tecnotree. While the operator in this case is launching a private network to offer 5G services, not only for their subscribers in the telecom domain, but also to other industry verticals in the market. So, for example, a community like a football club could potentially be launched on our digital stack using our platform. This is the ecosystem play that we strategically invested in, as called as Tecnotree Moments. So a lot of those types of services will also be rendered out of our platform. Definitely a lot of the AI/ML capability that we have built in the stack will be utilized in this particular opportunity. And definitely our customer management and billing products will also be put to use. So it's definitely very strategic as it's opening new avenues for growth for us in the European market as the European economy now stabilizes and is poised for restructuring and growth again.
If thinking about the cash flow, we saw an improvement as expected. And if thinking about the receivables, then accounts receivables came down, but the other receivables were increased and were on a high level. So what's behind this?
Indiresh, maybe.
Sure, I can take that question. As you can we have explained earlier as well, Roni, the collections sometimes had been very cyclical. And if you had remembered the 2023, we ended up the year with a negative 7 million free cash flow. Q1 we had of 24, we had a negative cash flow of 4 million. So that is when we started implementing some of the steps which helped us now to have 4 quarters of continuous cash flow. If we just take the quarter on quarter for the last 4 quarters, we have more than 4 million free cash flow what we have achieved in the 4 quarters. Yes, there is an increase in the other receivables, basically because of some of the contractual work what we do. While to bill it, we need to get their purchase orders and other documents. That normally takes in the Q1 of each year, that takes time. And I'm sure that we are going to bill them in the subsequent quarters. Also, one more thing I wanted to highlight is the quality of receivables also matter. Out of my total receivables today, nearly 50% of them are less than 90 days. As you know, our standard credit terms with all these customers are between 90 to 120 days, and 50% of them are within 90 days. So that gives us a confidence that our collections are stable, our receivables are good in quality, and we have nothing to worry about the receivable quality perspective.
All right, then we could discuss the outlook. Of course, the trade war and the tariffs has been a lot in the news recently. So how does the ongoing trade war affect Tecnotree's growth ambitions in the US? And have you experienced any changes in the demand environment?
Actually, for Tecnotree, I believe the trade wars have a very reduced impact and exposure, mainly because we are a global company listed in Finland, but serving global customers across different geographies. We have a global spread in terms of the product stack itself, but in terms of our delivery capability, we have continuously localized our capability in different markets and in different regions close to the customers, so that we achieve proximity, we achieve better governance and better delivery capability in the countries that we are serving. So this localization, while remaining global, is a very unique strategy that we have been following for several years. You look at Latin America, you look at Middle East, Africa, Europe and US. In all these locations, we have local people working out of our offices. And this gives us a very strong capability to look at the tariff situation and take advantage based on how we need to serve a given market. So I believe we've made these strategic shifts, which are going to remain positive from a growth perspective for us. And in terms of the tariff impacts in secondary in nature, in other words, as it unfolds, what impact it'll have on the consumer community, on the enterprises that are served by telcos. I mean, we have to wait and watch how that unfolds. There are definitely inflationary pressures and caution in terms of economic growth coming out of America. So I believe at this present moment, it's not a concern for us, but we are observing the trends. And telecommunication finally being a very essential service, we believe that the growth opportunities, as long as we have a highly productized and a highly performant, scalable stack, there will be several opportunities for us in the coming futures.
Okay, so we could end the interview with, if you could recap what are the main focus areas of Tecnotree for the rest of 2025.
I think delivering on the guidance, 100% will be a focus. We have worked very hard over 2024, the last 3 quarters, and continuing to focus on cash flow and operative cash flow. That will be a priority. And to ensure that in such a tough business climate, we remain cash positive. We will also continue our journey in diversification of our product stack, as well as geographic diversification, particularly to mature markets and dollar-denominated currencies, even in emerging markets where we work. As I said, emerging markets do have compelling growth opportunities for the company. We will continue to opportunistically choose different projects based on delivery timelines, based on currency risks, etc. And we believe that our embedded AI strategy in the product definitely has reduced the cost of ownership, improved productivity on the stack, and also differentiated the capability that we bring to our customers and the intelligence we bring to our customers. We will continue to invest in AI/ML, which will also reduce our capex to revenue guidance that we've given. We've already shown an improvement, but the productivity gains we get by embedding AI in even our development and delivery processes and operational processes will further help reduce the marginal cost of building our product stack going forward. And finally, the ARR focus on improving the accelerated annual revenue recognition through a subscription-based model with our customers is definitely showing green shoots, and I hope that more of that would be seen in the upcoming quarters. Thank you.
All right. Thank you for the interview, and I hope you all the best for the rest of the year.
Thank you.
Thank you, Roni.